So happy you're here. Today we're jumping into something super exciting together. SIP usually stands for Systematic Investment Plan, which is a popular way to invest in mutual funds. A systematic investment plan (SIP) is a method of investing in mutual funds where an investor makes regular, fixed payments into a chosen mutual fund scheme. Instead of investing a large lump sum at once, a SIP allows you to invest a smaller, predetermined amount at regular intervals like monthly, quarterly, semi-annually, or annually. Think of it like a recurring deposit, but instead of earning a fixed interest rate, your money is invested in the stock market through mutual funds, and its value fluctuates with market performance. Key principles and advantages of SIP. SIPs are popular for several reasons, primarily due to these core principles and benefits. Even if you only have a small amount of money from a part-time job, an allowance, or gifts, investing it early gives it decades to grow. Disciplined investing. SIPs instill financial discipline. By automating your investments, you commit to saving and investing regularly, regardless of market conditions or your immediate spending habits. This helps you build a consistent savings habit. Rupee cost averaging or dollar cost averaging. This is a powerful mechanism of SIPs. 5. When you invest a fixed amount regularly, you buy more units of the mutual fund when the net asset value, the price per unit, is low, and fewer units when the NAV is high. Over time, this averages out your purchase cost per unit, reducing the impact of market volatility and the risk of investing a large sum at an unfavorable market peak. Power of compounding. SIP leverage the power of compounding. Your initial investments, along with the returns they generate, are reinvested, leading to exponential growth over the long term. The longer you stay invested, the more significant the compounding effect becomes. Affordability and accessibility. SIP make investing accessible to a wide range of investors, even those with limited funds. You can start a SIP with amounts as low as a few hundred rupees or dollars, depending on the country. This eliminates the need for a large lump sum to begin your investment journey. Flexibility is key. You can pick your investment amount, how often you want to invest, and even hit pause if things get tight financially. SIP offer flexibility. You can usually choose your investment amount, frequency, and even pause or stop your SIP if your financial situation changes. Many SIP also offer top-up or step-up options, allowing you to gradually increase your investment amount over time as your income grows. No market timing. You don't have to stress about picking the perfect moment to invest. With SIPs, you don't need to worry about timing the market, trying to predict the best time to invest. Since you invest regularly, you participate in both market highs and lows, which is often a more effective long-term strategy than trying to guess market movement. Curious about how a SIP works? Let's break it down step by step, shall we? Here's a detailed breakdown of how a SIP typically works. Choose a mutual fund scheme based on your financial goals like retirement, child's education, down payment for a house, risk appetite, and investment horizon. You select a suitable mutual fund scheme like equity fund, debt fund, hybrid fund. So here's the deal. You get to choose how much you want to invest. Maybe it's $1,000 or $5,000. And then think about how often you want to do it. Monthly, quarterly, you decide. Set up auto debit. You provide instructions to your bank to automatically debit the chosen investment amount from your bank account on a specific date, each month, quarter, and transfer it to the mutual fund. You usually set this up using something called an electronic clearing service, or ECS for short. It's a super easy online process that makes everything smoother. Unit allocation. On each investment date, the mutual fund units are purchased at the prevailing net asset value NAV for that day. The number of units you receive depends on your investment amount and the current NAV. To find out how many units you get, just divide your investment amount by the NAV. Accumulation of units. With each regular investment, more units are added to your mutual fund account. Growth and compounding. The value of your accumulated units grows or decreases based on the performance of the underlying assets held by the mutual fund. Any returns generated by the fund are reinvested, leading to compounding. If you're in that sweet spot of 20 to 35 years old, consider snagging direct funds and growth funds. They can really boost your compounding returns over time. Monitoring and review. You can regularly monitor the performance of your SIP and the value of your investments. It's advisable to review your SIP periodically to ensure they are still aligned with your financial goals. Redemption: when you need the money, you can redeem your units. The value you receive will depend on the NAV at the time of redemption and the number of units you hold. Check out this cool example of SIP in action. It's all about rupee cost averaging. Let's assume you decide to start a monthly SIP of $1,000 in a mutual fund for 4 months. You put in a total of $4,000 over 4 months, right? That's commitment. Imagine this. In the first month, the NAV is 10. Then it jumps to 12 in the second month. But hold on, it dips to 8 in the third month. Finally, it bounces back to 11 in the fourth month. It's quite a ride, right? You've gathered a total of 399.24 units. It's pretty awesome, right? Your average cost per unit sitting at $10.02. Pretty straightforward, right? Notice how, even though the NAV fluctuated, your consistent investment of $1,000 allowed you to buy more units when the price was low. $8 in month 3 and fewer units when the price was high, $12 in month 2. This averaging out effect helps mitigate the risk of investing a large sum at a single, potentially unfavorable market point. If you had invested $4,000 as a lump sum in month 2, when the NAV was $12, you would have only received approximately 333.33 units, $4,000, $12. By using SIP, you ended up with more units, 399.24 units, for the same total investment, demonstrating the benefit of rupee cost averaging. By using the SIP method, you've snagged an extra 66 units compared to a one-time lump sum investment. That really adds up over the long haul, like 20 or even 30 years, you know? In conclusion, SIP are a powerful and accessible investment tool, especially for long-term wealth creation. They promote financial discipline, harness the power of compounding and rupee cost averaging, and allow investors to participate in the market without needing to predict its short-term movements. Take a moment to watch this video again, okay? It's super important to really grasp the key steps everyone should know. Trust me, it'll help a lot. What did you think of this story? Keep watching because there's so much more to come. Thanks for tuning in. Don't forget to like and subscribe. Catch you soon with more fun videos.